Welcome back, friends. So, we have seen the Federal Reserve finally begin the rate cutting cycle yesterday, and the news was received very well by the markets initially, with the Dow, S&P, Nasdaq shooting upwards before they started coming off after the press conference began. Now, Jay Powell did try to talk about a recalibration of the policy moves of the US Federal Reserve, and even justified his cutting the rates by such a substantial amount at the very first rate cutting cycle commencement. Jay Powell tried to explain that the US economy remains strong, resilient, yet they resorted to the super rate cut, which, if I may say so, 50 basis points. Well, history has shown that whenever you commence a rate cutting cycle with a 25 basis points, then the market goes up 10% over the next 1 year. But when you commence with a 50 basis points rate cut, then the market goes down 10% over the next 1 year. This is some of the historical analysis. That does not mean that the same is going to repeat this year. I just gave you some historical anecdotal evidence about what could happen as a result of the jumbo rate cut announced by Jay Powell and his team yesterday. Now, on Wednesday, Powell has lowered the Fed's benchmark interest rate by a bumper half-point cut to 4.75 to 5%, kicking off the central bank's first easing cycle in more than 4 years. The officials made clear that they were not stopping there either, with projections released on Wednesday with the dot plot showing that most of the Federal Open Market Committee, or the FOMC members, estimating that a policy rate would fall by another half a percentage point this year, followed by a series of cuts in 2025 to leave the rates at a neutral rate of 3.25 to 3.5%. Far from sparking panic, the concern of many ahead of the meeting, Wednesday's half-point cut was taken in stride by the financial markets initially. Major stock benchmarks and government bonds ended the day barely changed, but we found that the US 10-year bond, however, the rate went up a little bit at the end of the day. This was taking out some insurance to prolong what is a very good place to be in for the US economy. The decision is, of course, a bold move for the US Federal Reserve, and it comes just weeks before the November's presidential election has inevitably drawn a lot of criticism. Already we had the Republican candidate Donald Trump saying that a cut was either made for political reasons to help Kamala Harris, his opponent in the White House race, or because the economy is in very bad shape. The decision also capped a tumultuous period for Powell's leadership that has encompassed a global pandemic, the biggest economic contraction since the Great Depression, war, and also severe supply shocks that amplified the worst bout of inflation in 40 years. So I think that was a tremendous regime of Jay Powell. Many economists had doubted Powell could tame price pressures without tipping the world's largest economy into recession, and he has come out quite well in that direction. So all kudos to him. But 2 years since the peak of the inflation surge, it has been brought back almost to the Fed's mandated 2% target, while the economic growth has remained quite solid. In explaining this decision on Wednesday, the Fed chair framed a larger than usual rate cut as a recalibration of monetary policy to suit an economy on which price pressures are materially easing, while the labor market demand is also cooling. US economy, according to him, is a good place, and our decision, according to Jay Powell, is designed to keep it there. In the past, the Fed has typically only deviated from its traditional quarter point pace of policy adjustments when facing an outside shock, like at the onset of the COVID-19 economic crisis, for example, or when it became clear in 2022 that a central bank had misdiagnosed America's inflation problem. Federal Reserve's bumper cut was invoked without those kinds of severe economic or financial stresses, accentuated the Fed's desire to avoid an unnecessary recession. If Powell could put this kind of soft landing, then it would seal his legacy as a chair. Wednesday's decision reflected the Fed's efforts to balance the risks which are confronting the US economy. Having brought inflation into range, its focus shifted to a labor market where slower monthly growth and rising unemployment raised concerns over the last 2 months. Fed fully aware that from a risk management perspective, getting closer to neutral is probably the right place to be, just given where the economy is at. And that's about where it is, 3.3%, considering the real rate of interest rates and the inflation trajectory over the next few months to a year. The next step for the officials is, of course, figuring out how fast they should cut rates to reach that neutral level. In the press conference, Powell said there was not a rush to get this done. And the dot plot showed a dispersion among officials not only for this year, but also in 2025. 2 of the 19 officials who penciled in estimates thought that the Fed should hold rates at the new level of 4.75 to 5% throughout the end of the year. So there was a little dissent as well. Another 7 forecast only one more quarter point cut this year. The range was even wider for rates in 2025. So Powell will be tasked with forging a consensus on the FOMC, and having met one dissent at the meeting from Governor Michelle Bowman, who voted for a quarter point move rather than a 50 basis points move, which actually happened. That made her the first Fed governor to balk at rate decision since 2005. Friends, Bank of England, on the other hand, today has kept the interest rates unchanged after reducing it last month. And they feel it is better to go a little slower and to wait for the right opportunity to cut rates once again. You find that the sterling is today, the pound sterling is at the highest level since last 2 years, as a consequence of the Bank of England deciding to keep the interest rates constant and not going for a rate cut in this Bank of England meeting today. So this is the scenario in which the various central banks, there's also a possibility that the Reserve Bank of India may toe the line in its October policy meeting and also reduce the rates for the first time in many years. Friends, this is the scenario in which the world financial markets are headed. It's always good when the rate cycle starts, but there are many things and many economic indicators that you need to take into consideration when deciding where the stock markets are headed. To get to know more, do join our Prime or Prime Plus groups for the US markets. For the Indian markets, you can join the Premium Plus, which gives you 10 to 12 days predictions in advance. For all joining any of them, do WhatsApp us on 982-086-1044. Have a great investing day ahead. Take care. Bye-bye.